Dissemination of information. Accounting is known as the language of a business. It is the systematic recording, reporting, and analysis of transactions of a business. The person in charge of maintaining accounts is known as an accountant. While maintaining the accounts, it is necessary for him to follow a set of rules and regulations. This relevant financial information is presented in a structured manner and in a form which is easy to understand. The resultant is what we term as financial statements or financial reports. The basic objective of financial reporting is to facilitate the dissemination of information among different user groups. This would enable them to take appropriate decisions. Accounting information as a means to take economic decisions. Accounting is often called as the language of the business. Accounting communicates financial information from one person to another in the world of industry and commerce. Accounting provides information that is useful in making business and economic decisions for making reasonable choices among alternatives available. Examples for the same are: decide when to buy, hold or sell an equity investment. Assess the ability of the enterprise to pay and provide other benefits to its employees. Assess the security for amounts lent to the enterprise. Let us understand these in detail. When a company publishes its financial statements, the investors learn about the assets and liabilities of the company, the financial stability as well as management's prudence. This enables them to take decisions regarding buying, retaining or selling of shares and the appropriate timing for the same. It enables to assess the ability of the company to pay dividends. Financial accounting thus provides a scorecard by which a company's overall past performance is judged by outsiders. Accounting information as a means for predicting cash flow. Accounting information indicates the relationship between operating cash receipts and payments. This in turn enables in assessing the ability of a firm to generate cash from its operations. The same could be utilized to pay debts, reinvest in operations as well as distribute it amongst its investors. Thus, accounting information provides a clue to the liquidity and financial flexibility of the business. Accounting information to assist management in utilizing resources effectively. Accounting information which assists the management in taking informed business decisions is known as management accounting. Management accounting tries to attain various objectives. A few of them have been narrated here. To help the management in promoting efficiency. To study the actual performance with the one planned and also identify deviations and their causes. To enable management to formulate future policies. Thus, management accounting is a selective technique. It compiles only the data from the balance sheet and profit and loss which is relevant and useful. It is concerned with data and not decisions. It informs but does not prescribe. It deals with future planning. It examines the cause and result relationship. It studies the causes of profit and loss. Accounting information as a means for predicting earning capacity of the business. Accounting information provided by a company throws light on various aspects related to its performance, such as its current financial condition, timely payment of dividend and interest, repayment of debts by the company, cash flow ratio, number of projects in hand in near future. Thus, accounting information serves well in predicting the earning capacity of the business. To summarize, the basic objective of financial reporting is to provide information that is useful in making business and economic decisions. The main qualitative characteristics of financial statements are: 1. Understandability. 2. Relevance. 3. Reliability. 4. Comparability. The information requirement of users varies from user to user. Thus, a fine balance should be maintained while disclosing the same. That is, neither it should be too much of information that it loses its relevance, nor too little that it does not serve any purpose. Also, financial reports should provide information which is understandable to all and should contain all relevant information required. For this, the information should be such which assists in decision making. Information provided through financial reports should be capable of making difference in the prediction about the outcome of past, present, and future events, or to confirm or correct expectations. The quality of relevance has two components, namely feedback value and predictive value. Feedback value is the quality of the information to confirm the outcome of the predictions made in the past. Predictive value means value as input into a predictive process. Also, the information should be made available when it is required. Otherwise, it will be irrelevant to the decision to be made. Information must also be reliable. Information has the quality of reliability when it is free from material error and bias and can be depended upon by the users. And last but not the least, information must also be comparable. Based on the information, economic decisions are taken. Decisions involve selecting the best available alternative. The best alternative could be selected only when a comparative study is possible amongst all the available alternatives.